what we realized that 50% of a stock's move comes from the industry it is in. So if you are a part of the right industry, half of your job is done, right? We saw that with private banking in the last decade. We saw that with consumer stock uh, in the last decade. Before that, in from 2003 to 2007, we saw that with real estate. We saw that with infra names, some of the metal names. So there are periods. We saw that with pharma stocks in the middle. So it's very important to be in the right sector. So we run our screeners in such a way so that it gives us, and that part is proprietary, how we decide which sector is leading. But it's based on many parameters. And so one is sector. The second one is price. So I think price again is so counterintuitive, where everybody is actually looking for stocks that have fallen. It's a normal mindset that, okay, oh, the 52-week, it's near its 52-week low, let's buy it, must be cheap, right? But what we've heard and what we've done, and what in fact we've done a lot of study and a lot of backtesting, where we've compared stocks. Suppose a system was buying stocks making 52-week highs versus buying stocks which were making 52-week lows. The stocks where we bought 52-week highs, that portfolio has done much better versus portfolios where we bought 52-week lows, right?
Today we have Mr. Harshvardhan, Patwardhan, and Varun Daga from Team Girik Capital. And this is why I call it unique, because we have been hearing a lot of fund managers, a lot of portfolio managers who kind of follow bottoms up approach, and whether it be a kind of a market driven by macro risks, or it be a market which is throwing a lot of opportunities. Some of these bottoms up portfolio managers always kind of talk about that macros is only kind of entertainment, and one should not too much follow on macros. One should follow bottoms up approach. One should follow on the fundamentals of companies. However, we know that for last 6-7 months, equity markets have actually moved nowhere. We have been gradually consolidating. FIs have been consistently selling. So what is it that top down approach is telling us is the actual way and actual theme of this webinar that we want to understand from Team Girik Capital, which are the ones that follow top-down approach.
So thank you everybody for joining today. This is the first time we are doing something like this with the PMS AIF team, and it's amazing what a platform they've created so that upcoming PMSs and all the returns get captured well, and people and investors can take informed decisions. So what I'll do is I'll quickly talk about Girik and what we really do here. I don't know if a lot of people have heard about us, but we've been in business for now almost 13 years. In December we'll finish 13 years, and it's been a long journey. It was started by Charandeep and me 13 years ago, and the whole purpose of us starting Girik was that we wanted to give and deliver a very differentiated product to the market. When we started Girik, I think everybody in the market was in the complete value basket, where everybody wanted to buy value, look for cheap stuff, something trading very cheap at lower P multiples. But at that time, we were following this gentleman called William O'Neill, who was following the style of CANSLIM style of money management, which we thought was an amazing style to manage public money. And it's been 13 years now. I'll talk about that style a little more. But a key features about Girik is that we are a boutique fund managers. We do not chase AUM. So after 13 years of history, with in the market, we are still at about 1,000 crore of AUM. So I think one thing we've always focused on is returns, right? We When Sharandeep and I started, we always believed that the AUM will come, it will follow. What we need to focus totally is only on returns, and once the returns come, the power of compounding will automatically make it happen. uh, some other things is that, we have a single product, so all our eggs in one basket. So we do not do many strategies. We have one strategy, which is a multi-cap strategy, which is divided between large, mid, and small. So about 50% is large cap, and about other 50% in mid and small, so we cover the entire range of market cap. uh, Another thing is that about 15% of our AUM is our own money. So we have always kept pumping in whatever money we made in the business, whatever money we saved, we always kept on putting it into this strategy. So the whole purpose is that our interests are completely aligned. We do not do any other business, so this is the only business that we do. We do not run a broking shop. We do not do merchant banking, no private equity, uh, only the PMS. And we also have an AIF, which also runs the same strategy. Uh, so the idea is to be hyper focused. We invest in about 25 to 30 businesses at any given point in time, and our only objective is to deliver returns. We do not have a massive sales team to garner AUM. We've always believed if we stay in the business for 20 years, it will automatically happen. So the idea is to grow into our size rather than by size. And we've done that, and we've only partnered with very few distributors you know who think like us, and who can be with us for the long term. And about 70% of our AUM is direct. Just a few things about our performance. So this is one slide, in fact, put up by PMS AIF World, where we've ranked among the top, in the 10-year performance, 5-year performance. If you see this, we've at about 23%. This is post fees, post all expenses, for a 10-year period. Since inception, which is 2009, we are at about 20%. 5 years, we're about 18. 3 years, we're at 22. Uh, we think anything below 3 years is just noise. In equity, if you're at least, you should be looking at a minimum period of 3 to 5 years. Any decent fund manager should be able to give you good returns in that period. And we've been ranking well. This is another award which we got by PMS AIF. They've made us a little famous, but we've always tried to be under radar, under the wraps, so that we don't get carried away by performance. And the focus still remains for our entire team to just keep delivering. Every day we come to office to find new ideas and to perform for our clients. Another, I think it was well covered by these guys at Bloomberg, how we managed with a very different style. We have a style of buying high and selling higher. So again, it's such a big misconception, and every time, people talk about, oh, we want to buy at a low price, but our entire style is actually designed to look at stocks that are making new high, and how we can find winners from those companies. And what's amazing is that if we are looking like that, we'll never miss a multi-bagger. So I remember when 2010-11, when Bajaj Finance came up on our screeners, because it was hitting a new high. It was a 3,000 crore market cap, and trust me, at that time nobody even knew that Bajaj Finance had a consumer business. Cut to 10 years later, today it's a 4.5 lakh crore market cap. So uh, great businesses can be found by looking at how, when the prices are making new highs, when the earnings are accelerating. And these are some of the features of CANSLIM which we really thought was very, very fascinating and really out of the box compared to any other managers out there, because it just keeps us unbiased. The whole approach of investing, what we're trying to follow, is a very unbiased approach. We don't get want to get married to a HDFC Bank or an Asian Paints. We feel that money can be made in many, many pockets. And we should have an open mind to understand that. And once you have an open mind, when the stocks come up on our screeners, it's very, very nice that one can make money in different areas and different sectors, and there are great companies in every sector. So just coming to our performance, we've done about 10x, 10.14 times in the last 12 years, versus the Nifty, which is done about 3.4 times. So we've managed to beat the index pretty handsomely. You've seen this, but just in comparison with the Nifty and the other indices, we've in every time frame we've stayed ahead of each of these indices. So whether it's 1 year or 3 years or 5 years or 10 years, and we believe a firm with a 10-year track record really is credible, because we've seen cycles, we've seen times of COVID, we've seen demon, we've seen the 2011 to 2014 period where markets just didn't do anything. And what we've seen is that investors have had this journey where at that time the minimum investment was 25 lakhs. Some of those investors today are sitting at corpuses of 25 crore, because they've been with us, they've added. So we've always felt that investing is not just giving your money to the manager. It's also it's like a partnership where you build your portfolio together, you set goals, you have visions for the next 10 years, and how you're going to get to a target. So we actually help clients sit with us, build their target, build their goals, and at different rates of growth of compounding, where will they be after 10 years. And we also design how they can add at every level. They'll add an SIP. And also now what we've started doing is we've also started giving them plans of withdrawals, how they can withdraw after 10 years, 15 years, so that they can take care of their life in the later part of their life. So it's not just about gathering assets, it's also about making it grow and distributing it back to the investor so that he can make use of the money that he's earned. So I think it's a journey, it's a partnership between uh, fund manager and the investor, and that's why we've kept it very, very boutique. We know every single one of our clients, and we interact with them personally. We manage about 140 odd families. So the idea is to keep that boutique nature, so that otherwise you could be a great manager, but if you pull out money at the wrong time, let's say COVID hit, and if you take out your money, even Warren Buffett won't be able to perform. So the idea is that we have that relationship, we have the communication going, so that you stick around in good times, bad times, and we can deliver over periods of time. And also, what we've seen, that in times of turbulence, most of our clients, whenever we've called them, they've added money. So in COVID, we didn't have a single client leave us. In fact, many of our clients, because they've seen us through cycles, they had the confidence to add, and they started SIPs, they started putting in small sums of money, which is amazing, because in those times it's really, really tough to take that decision. But as Harshad showed, that over the long period of time, everything else is noise, but equity returns do compound, because the great businesses get better, and the weak businesses will fall out. And even though many times stock market is doing very well and economy is not doing well, and everybody's wondering, yeah, what is happening to your stock market, it just keeps doing well. But the market is made of 500-600 companies which are the best in class. They have the best management, they have the best capital allocation, they're well funded, they have good talents, they can invest in technology, and I think that makes them very, very unique. They're well governed. So I think these things actually gives them a winner's curse, right? They need to perform, and being in the market, we have a choice to be with them and participate in their growth journey. This is our performance compared to the top performing mutual fund. We've been ahead of each one of them since inception. I think this is the most important slide. Uh, it talks about how have we fallen. There's this perception that mutual funds are safer and index investing is safer, but I think it's the only way to look at that is how did a fund do, or how did a PMS do in the times of crisis. And there's been about 6 times where markets have really crashed since we have started, and in each one of those falls we've fallen less than the Nifty as an index. So even if you look at the bottom right, where the Nifty fell 38%, this is the COVID fall. In 3 months everything collapsed, and the small cap and mid cap fell more than 50%. We were down about 22%. So I think it's the biggest mantra about our Girik, and the biggest philosophy for us is to protect investors' capital. So we are very, very fast at cutting risk. We believe that in the Indian equity market, if you can manage risk, the returns will follow. You will always get times, what we've seen in the last 2 years. It's very easy to earn returns if you manage to protect risk. So a large part of our focus, we have a lot of meetings, we have set up a lot of systems so that we can protect risk, so that in the times of crisis, investors don't lose money, and don't lose capital. Because if you're down 50%, it's very hard to come back and break even. So if an investor came to us in Jan, we would have anyways deployed his money very slowly, and he would have been down at the bottom of COVID about maybe 8-10%, which is very easy to come back. So it's also important how you allocate new money. So we do follow model portfolio approach, but we do not just buy at any price. We take our time to invest that money slowly, and over a 3 to 6 month period, that portfolio gets completely aligned to the model portfolio. So this is our approach. We've built a lot of processes, a lot of systems. We've done a lot of back testing to put our screeners, so that we get the right ideas. We know which sectors to focus in, so that we can deliver for you and protect returns at the same time. So I think I'll probably stop here. So we are about 1,000 crore in AUM, uh, and Deloitte is our auditor. HDFC Bank is our custodian and banker. As I said, we run a single strategy, and I think Kamal, if there's any questions here, or I can also talk about the organization structure quickly, and then we can take questions.
Sure, you can maybe spend 2-3 more minutes, then we'll start questions.
Perfect. So quickly, Charandeep and I started Girik, and Harshad, with his over almost 3 decades of experience, has joined us recently, just 4 months ago. He was CIO at JP Morgan Asset Management, and then at Edelweiss AMC, and he's been a veteran in the market. So we're very, very proud to have Harshad with us, an IITian, an IIM, and a CFA. So has everything under his belt, I think. But more than that, we met a lot of people in the market. But with Harshad, we really felt that he completely understood our philosophy, bought into what we believed in, and about risk management, about screeners, and we are really working hard to build on it. We've put in a lot of systems to build on the screeners that we've built, so that we can turn around ideas much faster. And because we felt that even in the last 10 years we've missed a lot of opportunities. We didn't squeeze it as well as we could have. So and all we want to do is do better every day. So I think that's the culture at Girik. We try to be like a startup every day, and keep working towards making our systems better, automating a lot of processes so that we can take decisions faster. So this is just three of us at the investment team committee. We together we take joint decisions. A quick background about Charandeep: he was with Lehman for almost 10 years. Before that, he was at LSC, and he did his masters at LBS, London Business School. And after that, he came to India to head Lehman India. And then we met in 2008, 2009 actually. And the same year we said, let's start Girik in our first meeting, and the rest is history. It's been a lovely partnership, and I think the best is ahead, and we're all looking forward for that. This is our core team. Again, very, very experienced, and been with us for some time now. And they all cover different sectors, but at the same time, we have a process of our analyst who can jump into from one sector to another. We have a second analyst to every idea, so that if the primary analyst is away, we have somebody covering up those ideas. So it's a very, very motivated team, always hungry to show us ideas. So we try to turn it around very fast. We have a couple of guys on the technology side, which is data analytics and portfolio allocation and risk management side. So they have very, very experienced, both Praveen and Deep. And Deep has been with us for the longest time, since we started. And Praveen, in fact, joined us with Harshad. He's been with Harshad from the beginning, analyzing data using Bloomberg. And it's great to have such lovely people. And then we have our investor relationship team, so headed by Saurabh, Yash, and Umita. So we do not really have a sales team per se, but anything the investor wants, they can always get in touch with our investor relations team. Any reports, any data, calls with fund managers, we are always available. So we've always kept it very, very open as a culture, and giving you that experience of a boutique manager. So yes, I think that's a quick one on us.
Right, Varun, thank you so much
I
for
guess.
presenting. And it's actually, I have gone through this multiple times. So to me, it was not new, but I can tell everyone, on behalf of Team Girik Capital, we, as a platform PMS AIF World, represent more than 200 portfolios. And based on our own quality, risk, and consistency parameters, we have our list of maybe you can say top 20 PMSs that we focus on when it comes to aligning with our clients. And Girik, multi-cap portfolio is one of them. It comes in top 5, and actually it fits, to certain those investors who are actually wanting to invest in a different way than just bottoms-up approach. As in terms of examples, Varun was trying to explain a portfolio which is unique and different from names like Asian Paints and HDFC Bank, but at the same time is able to actually, add a company just before it starts its kind of a long-term bull run. I know in during COVID period from April of 2020 till October, most of the fund managers did not have an idea what is happening and why Tata Steel is rising. I'm just giving an example. And then we saw commodities as going up. Many fund managers out there who had their thought process that commodities is a no, and they were not wanting to add such businesses. They kind of entered very late. But through screeners and through top-down approach, Varun and his team were able to actually identify that, and this is just one of the examples. Before that, when Varun is saying that their strategy had fallen 22% versus Nifty falling by 38%, that was also because of some kind of an understanding through their screeners of trying to cut risk and maybe reduce financials in the portfolio and move to the defensives. So all this we have practically seen, and our investors have also seen, and that is what Varun explains and Varun conveys as canceling strategy. And Varun, now we have actually given a lot of I would say backbone about Girik. But the point here is, many investors are out here wanting to understand what is this canceling strategy. Investors are aware of value style of investing, growth style of investing, growth at a reasonable style of investing. These are normal, I would say, bottoms up approaches that a lot of fund managers talk about. But what is the CANSLIM style, and how do you guys follow that? What do you mean by screeners? And first is theoretically, kindly explain this, and secondly, practically, what is it saying today in the current context in terms of sector choices, in terms of risks, and how are you guys managing that? Now, in the second half of this discussion, over say next 10-15 minutes, I want you to cover this aspect.
Sure, sure. Thanks, Kamal. I think well talked about the metal strategy, and it was so funny when some of these metal stocks like Hindalco and Tata Steel and some of these stocks, when they came up on our screener just after COVID, we were really shocked. And but learning from the last 10 years, we realized that we should never ignore it. And for the first time, we worked on metals, and I can tell you at that time nobody had any clue. Nobody really understood metals. In fact, industry had not researched metals for the last 15 years. And we said, okay, let's listen to our screeners. And when we looked at Tata Steel and Hindalco, we thought it was a no-brainer, because the earnings were accelerating, the numbers were looking very good for the next 1 year. And in fact, that year, both Hindalco and Tata Steel were the biggest large cap winners in the market. So it's interesting how the screeners do throw up names, and it gives us that early signals. Now let me just talk to you about what these screeners are. So uh, it's very counterintuitive, but we've done a lot of back testing in different markets all over the world. And in fact, CanSlim approach, which is done by William O'Neill, they have also done a lot of back testing in many of these styles. And what we did was that we did, we actually put up screeners based on price, based on earnings acceleration, and based on industry. Why we took these three factors is, again, we did a lot of trials and errors and stuff like that. But what we realized that 50% of a stock's move comes from the industry it is in. So if you are a part of the right industry, half of your job is done, right? We saw that with private banking in the last decade. We saw that with consumer stock in the last decade. Before that, from 2003 to 2007, we saw that with real estate. We saw that with infra names, some of the metal names. So there are periods. We saw that with pharma stocks in the middle. So it's very important to be in the right sector. So we run our screeners in such a way so that it gives us, and that part is proprietary, how we decide which sector is leading. But it's based on many parameters. And so one is sector. The second one is price. So I think price again is so counterintuitive, where everybody is actually looking for stocks that have fallen. It's a normal mindset that, okay, oh, the 52-week, it's near its 52-week low, let's buy it, must be cheap, right? But what we've heard, and what we've done, and what in fact we've done a lot of study and a lot of back testing, where we've compared stocks. Suppose a system was buying stocks making 52-week highs versus buying stocks which were making 52-week lows. The stocks where we bought 52-week highs, that portfolio has done much better versus portfolios where we bought 52-week lows, right? So we've done a lot of studies like that. But what we realized is, when we uh, put price as an indicator, uh, for example, in COVID, when the market crashed, uh, we we would look at stocks that are coming up first and making a new high. to give you some examples, we made a lot of money in Dixon. We made a lot of money in India Mart. Some of these, a lot of these IT companies which came up very early on our screeners, and they were making new highs. And not just this time, every fall when it happens, if you can find an idea that is making a new high, and that automatically comes up on our screener, because it's also relative. It's not just that, oh, it's made a new high, so it will come up on our screener. No, it's relative to everything else. So if, let's say, markets have fallen 20% and the stock has not fallen at all, that just tells you that there is a lot of strength, and maybe something is changing in that company. So what that does is it forces us to look what is happening inside that company. It's like, when Eicher first came up on the screener, I can tell you nobody knew that there was a Royal Enfield business inside it. Bajaj Finance, nobody knew that there was a consumer finance business inside it. So, and like that, it just happens all the time. When Dixon came up, nobody knew that there was a PLI scheme going in. So a lot of these stocks, I'll tell you, when CDSL was a great example. We had CDSL and Angel, and when we were buying Angel, everybody thought, are you guys crazy? But it was again one of the biggest winner, both CDSL and Angel, because the sector again was doing very well. India was adding about 20 lakh broking accounts a month, and it's only accelerated after that. Today Angel opens almost 5 lakh accounts a month alone. So it's interesting how some of these businesses were so small, but they came up on our screener very, very early, and we could act on it because we had an open mind to see it, right? I'll give you an example. Recently, some retail companies like Shopper Stop came up on our screener, and you know what? And we were like, okay, what is this Shopper Stop coming up on the screener? It's such a it's never made money for investors and this and that. But when we looked at it, we realized that the Westside CEO has joined Shopper Stop. So a lot of times when you look at price, you realize that something fundamentally has changed in the company, and that's just a starting point. Many times, 8 out of 10 ideas we'll just avoid because of governance, because of many factors. But what this does is it will never let us miss a multi-bagger, because when the price is going up, if it has to go up 20, 30 times, even if you catch it when it doubles or goes up 50, 60, 70%, it's okay, as long as you look at it and then decide to say yes or no. Most of the time, when the stock has already gone up 100%, it's a human bias which says that yaar already chal gaya, ab kya hoega, and that's why a lot of people, a lot of clients say, yaar main jab bechta hu uske baad hi chalta hai. Because why that happens? Because it's greed that comes in, which makes you sell the stock because it's gone up 50%, but maybe that's the next big winner. So we believe that there are winners in every portfolio. Even your portfolios will have winners, but what CANSLIM has taught us is to ride our winners. It's very important to ride your winners and cut your losers. I think if one can do that well, they can make a fortune. The biggest mistake people make, especially retail investor, and a lot of ego comes in that, oh, I bought it at 100 rupees, how can I sell it at 90? How can I sell it at 80? And you feel that how can I make a mistake, right? I did all my analysis, but markets are very, very dynamic. Things are changing very fast. 30 rupee crude can become 120 rupees, and it can change the face, it can change the fundamentals of companies. And I think being in the equity market, especially in the listed space, there's no reason to be wedded to a stock or a sector, right? If something fundamentally has changed, one should get out. So what we do very, very carefully is, when something is not working for us, we go back to fundamentals and try and understand, has something changed fundamentally? So if the stock from 100 has become 90 and everything else has done well, we will always go back and check what has gone wrong. And most of the times we'll find something that has gone wrong. Similarly on the upside, right? So I was talking to you about, one was the sector, the other screener was the price, which again is very, very important. We believe it's such an underrated thing where, you know, people don't give importance to price. But I can tell you with experience, there is so much fundamental hidden in price, you know. And a lot of times, you know, if you want to play a story for 3 to 5 years, it doesn't matter if you miss the first 50%, but if you can catch the next five bagger, I think that's what's important. And price helps you do that. It helps you catch the right stocks at the right time. You know, we don't want to play the waiting game where you're sitting at ITC for 5 years or holding it for 5 years and hoping ki one day it will do well. You know, value could remain value for the longest time, but it's important, you know, to find value. You can find value at a new high. You know, it's, I'll tell you, when we bought DMart at listing, it was very expensive. But today, you know, when it's up 5 times from there, now if you look back, it looks very cheap. So it's at that time things might optically look expensive, uh, but when you look back now, then it looks cheap. You know, Angel was about 2.5-3,000 crore market cap when we bought it, right? Today, it will do almost, it's run rating at a 200 crore pat a quarter, which is almost 800 crore pat a year. So imagine practically at that time it was trading at a 3p, right? So a lot of things in hindsight, you know, when you look back after 5 years, 7 years, you realize how cheap it was, right? But at that point, optically, it looks expensive. So just looking at a mere P ratio, I think it's a mistake. The third thing is earnings acceleration. You know, again, what we have learned with all our backtesting is that earnings acceleration is what creates the maximum value in re-rated. So we've seen, you know, 15, 16, 20p stock go to 100p because the earnings were accelerating very fast. Again, a great example, one of our investee companies, Tata Elxsi, you know, because the earnings started accelerating, the P multiple just skyrocketed and nobody in the market understood what happened, right? And similarly on the downside, when earnings starts decelerating, you know, suppose it was growing at 40-50%, now it starts growing at 10-12%, you know, you will see multiple starts to collapse to any level. You know, it from a 70-80p, it could start trading at 15-20p. That can very well happen with any company. So it's very important to keep these things in mind, and after that, do your fundamental analysis. So we actually do like a, you know, it's a bit of reverse engineering, where we our system, our screeners actually tell us this is where your maximum money can be made, and then we look at those stocks rather than us using our own mind that you know, this is where we can make money or this is where we can make money. And then after that, I mean, after that, we all do the same thing, right? We obviously look at governance. We look at, one thing we look at very important is leadership. You know, we want to buy businesses which have, of course, a great management, but which have leadership. You know, it should have leadership in products. It should have leadership in processes. It should have leadership in margins. And I think what, you know, that does is that, you know, it will always surprise you. A leader will always surprise you. We've seen that with a Bajaj Finance. We've seen that with a you know, DMart, where many people I know bought a future retail, saying DMart bahut mehanga hai, let's go and buy future retail. Now, what, you know what that did, right? One company just became, you know, five bagger, and the other one went bankrupt. So it's again very, very you know, it's very, very wrong to go and buy a third, fourth, fifth guy just because it's cheap, right? You cannot compromise quality for price, right? So again, we don't like to pay any price for quality. Again, that's very, very important for us. We want to pay price, but where there is acceleration in growth. So where we know that, okay, this company can grow at 40-50%, can grow very fast for a long period of time, has a long tail, has a great management, interests are aligned to minority shareholders, governance is good, we will go and back that company because we know 3 years later it'll look cheap, right? So you know, I think that's a quick one on our strategy. I'll give you a quick background on CANSLIM. So CANSLIM actually is not a not a weight loss formula. It's actually each of those letters mean something. So C actually stands for current earnings acceleration. So as I told you, earnings acceleration makes a very important thing. So if your earnings are accelerating, that's when your P multiples get upgraded. More and more analysts starts covering it. Mutual funds come and look at those stories, they buy it. Also, a lot of times analysts in the market can't imagine that a company can grow so fast, because it's we cannot say, oh, oh, Bajaj Finance, 10 years ago, nobody could have predicted that it's going to grow at 40-50% for such a long period of time. So a great business always surprises. That's why when the earnings acceleration is very fast, especially the current quarters, there could be a winner out there. That's what we are looking for. Then A stands for annual earnings. Again, it's just not a current quarter is not enough. It should have a history of annual growth. And otherwise, sometimes it could be a one-off, it could be a commodity cycle, it could be just some end product prices have gone up, so it could be one-off. But you want to see a constant consistency in the last few years also. Then N is very important in CANSLIM, which we use a lot of times, and we give it a lot of importance. Whether it stands for new product, new services, new management. So when management change hands, it's an amazing sign. It's very interesting what a new guy can do. New IPOs also, because again, with a lot of our backtesting, we realized that the first 8 years of listing makes the maximum money, for in the period of that life cycle of that stock. So it's very important to look at new IPOs, and it's usually done well for us, whether it was DMart, Angel, Jubilant Food in its earlier times, prime times, and you get to analyze a lot of businesses which are very new and fresh. uh, and it's exciting to look at new businesses, and sometimes you find good winners and companies which are accelerating at a very fast pace and could make a lot of money. Then you talk about supply and demand. So this is something, a technical part of it, where it's very important to understand what is the kind of supply that is there. If there's too much equity out there, if the promoter, if the company is diluted again and again, and there is too much free float, usually it will not get a very high multiple. It's very tough because that much supply is there for you to absorb the demand, right? So it's important to look at, we've seen that happen all the time. A lot of companies where promoters hold 75%. Look at all the MNCs, there's no supply. That's why they trade at 50, 60, 70 times, even so many times when the earnings are also not coming, right? Because there's no supply, nobody's willing to let go, right? So it's an important part of the market, right? Because the whole purpose of CANSLIM is how can you make money, right? How can you deliver the best return at the fastest pace, and what are the key elements that can make you do that? So supply and demand again is very important. That's the S in CANSLIM. Then I talked about leaders. Is your stock a leader or a laggard? Always back a leader. So leading industry and leading stock of that industry. So find a great industry which is good, which is leading. Again, we have systems to do that. And then it's our job to find, okay, which is that company which is a leader. The leader doesn't need to be the largest company. It could be the second largest or the third largest, but it should have leading metrics. It should be leader in its category. It could be like, for example, CDSL was a very small company when we looked at it. It was a 3,000 crore market cap, but it had leading metrics. It was gaining market share from NSDL. All the discount brokers are only with CDSL, right? Or 90% of the 95% of the new broking account that was opened was opening in CDSL. So it should have leadership. The incremental market share that is getting absorbed by, or that is getting taken up by some of these companies should be from these leading companies. So it could be the second, third player, but it should be in the race to lead. It should be a disruptor. Like we felt that Angel was disrupting many of the old brokers. And today it's growing much faster than your traditional brokers. and also earns a lot more money than that. So at that time it wasn't a leading company, but it had the leading mindset, it had the leading numbers, and today it's become a leader. So leaders is very important. Then institutional ownership, again, very very important thing. What we've learned is that when institutions starts to own a stock, as more and more money flow comes in, they end up, so institutions, what we've realized is, your large mutual funds, they cannot buy a company in one go. They usually take time, right? They could take 6 months to a year to accumulate a position. I think as a nimble PMS investor, we can understand it very fast. We know that, okay, institutional ownership is growing. That means this company is being liked by institutions. Let's say there used to be a 10% ownership. Now this quarter that's moved to 15%. We know there is going to be a lot of buying going forward. And when the earnings are accelerating, more and more institutions will come and buy it. And that's what creates P multiple increase. So that's why the I in CANSLIM is institutional ownership. Is it increasing or is it decreasing? Right? Is it going to increase or is it going to decrease? Right? So, and similarly, it could be the other way. Sometimes the institutional ownership is so high that the only place to go is down. Like for example, HDFC Bank, right? There's so much institutional ownership that the supply, if somebody decides that, okay, I want to move from HDFC Bank to ICICI Bank, the P multiples can really contract, and people will be wondering, why is HDFC Bank, it used to trade at 4 times book, why has it become cheap and cheap and cheap and cheap? But one needs to realize there's so much supply, and if that supply keeps coming in and people want to move to other players, then the demand can become a supply, right? And that's what can keep the stock price not perform for the longest period of time, right? So it's an important factor to look at. And the last one is market direction, which I would say probably we give it the least importance, because being in India, we realize that we are in such a structural story for the next 20 years. We believe that markets can do whatever it does, but if we have a good risk management, so we do take care of direction, but our risk management is it covers all that very very well. So like we saw, even in COVID, we were down only 22%. So it takes care of that. But what we try to do is we try not to bottom fish. We try not to catch a falling dagger. We would like to see companies lead from the front, both in terms of price, in terms of earnings acceleration, and in terms of growth, so that once we enter a stock, it starts to work for us at all times. And we like to build a portfolio of 25 to 30 stocks that is working for us at all time. So that's a quick background on CANSLIM. One thing I will tell you, what Girik has added to a lot of these systems, and we've taken it to the next level, is we pay a lot of attention to liquidity. Today we can sell our entire 1,000 crore within a week. It's extremely liquid portfolio. We don't get into illiquids. We balance our positions very well. Even if we love a stock and if it's illiquid, we won't buy it. If it's semi illiquid, then we'll start with a very small position and let that position grow. For us, it's very important. If we go wrong, and I'll tell you, we go wrong a lot of times, and everybody goes wrong, but not many people accept their mistakes. So if we go wrong, we should be able to cut our losses very fast. Accept our mistake, because there's always a new idea waiting for us, right? Our screeners are always throwing new ideas, and all we got to do is work hard, understand its leadership, understand its management pedigree, understand what is the tail of growth, how is it going to grow for the next 5-7 years, and then pounce on that idea. But if you are just stuck with your laggards, then there's a lot of opportunity lost where one can miss the winners. So yeah, I think that's a quick one on CANSLIM and our style. We can take some questions if there is any.
Right. Thank you,
If you
Varun.
want to add anything.
No, I think you have covered pretty much everything. and we have completed almost 1 hour. But it is a very interesting conversation going on, so we'll take it ahead for 10 more minutes. I would want to understand from you. You know, you had mentioned one very pertinent point which struck my mind, that 50% or more than 50% of stocks return comes from its sector, and hence, you know, identifying which sector is going to lead the next bull run is your first and foremost aspect, followed by price and a lot of other factors that you've covered. Now, in that context, what I want, you know, you to kind of share what is it that your screeners are sharing today. So, because there are questions I can see on chat box where the example of stocks like metal stocks you took, you know, investors want to understand: are you still, is your screener still saying that Tata Steel is a buy, or you know, what are the sectors that your screeners are throwing right now? Because that is actually, you know, more important aspect, and will explain more on the flavor of your portfolio also in terms of your top holdings or top sectors for investors to get more practical understanding of your portfolio.
Sure. No, I think that's a very, very valid point. And, in times like these, it's always confusing that which are the sectors that are going to go out of flavor and which are the new sectors that will emerge and come. I think one theme, and Harshad, please feel free to join in. One theme which we are seeing very, very clearly is the reopening trade, whether it's hotels, whether it's, some of the retail stocks, we own, for example, Indian Hotels, we own Shopper Stop, we own Trent. So we are really seeing that some of these reopening trades which are run by good managements, where something is changing, right? Like if you look at for example, Indian Hotels, they've completely changed the way they think, right? They've become much leaner. They're really looking at profitability. They have a clear plan for the next 3 to 5 years. They've gone into management contracts, so they're not going to do capex. It's going to become very, very asset light. They've gone into many new models, and a lot of exciting things happening there. So we thought that was very interesting. In Trent, again, expensive, but what we are seeing is that what they're doing in Zudio, which is another format. So they were very, very successful. In fact, I would say the only successful clothing retailer out there in the country, did very well with West Side. Now they're obviously, launched something called Zudio, which is a little smaller format for, more value sensitive buyers. But you can go open that anywhere in the country. Small villages in the country, you can go and open a Zudio because it's priced very, very well, and a phenomenal model. You can scale it up very fast, and we've seen that with Tata, right? When they get their model right, we've seen that with Titan, what they did with Tanishq. uh, so we feel that what they could do with a story like that is very, very interesting. They have huge plans to add Zudio, and again, we think that the earnings acceleration for the next 5, 7, 10 years would be very, very good, and it has a very, very long tail. uh, Shopper Stop, again, coming back to CanSlim, we saw the newness there, where the West Side CEO came and joined, and he's talking all the right things. And we felt that it was at a reasonable market cap. We still, of course, we've started a position, but we always build on it over time slowly, and we're doing more work on it. But what we like, what we see, and I think why we bought these is because we are seeing some kind of traction and money flow into, even though it's not a very large sector, but stories which are linked to opening up. So again, it's not one sector, but it's a theme, you can call that. Other than that, we had IT and metals that led the bull market. But I think leadership in IT, we've seen it go a little sideways for some time. It might come back, but for now, what will happen is that when the markets come back, we will usually, when the markets are falling, it's tough to find that leadership. But what we look for is the stocks which emerge the first, right? So right now we are seeing some of these opening up trades which are emerging, and which could lead. In fact, even on the financial side, we are seeing, you know uh, the the leadership is completely gone. You're not seeing leadership in your Bajaj Finance of the world, in your HDFC Bank, the private banks. The leadership could come from somewhere else. You could have companies like Chola, which is which is linked to the CV cycle. So that could lead, and it's again doing something new because they're acquiring businesses, they are growing very fast on their newer initiatives. So again, it could be very, very interesting play. And I'm not recommending any of these, but I think it's very clear what has worked in the last 10 years might not work in the next 10 years. And be ready that you might see that the darlings of the I remember 2007, you had all your real estate, and ONGC was about 8% of the index, SBI, L&T, these, it was in every portfolio. Like today's HDFC Bank and Asian Paints and Nestle. And, so what happens is that even those were great companies and these are also great companies, but times change and cycles change. And what has worked in the last 10 years might not work in the next 10 years. And that's what our screeners tell us. We are looking at Chola, we are looking at Credit Access, we are looking at companies which we can't even imagine that we would have looked. And these are big companies, large companies, growing at a very, very fast pace. Maybe they become the next Bajaj Finance, right? So I think the jury's out there, Kamal. We've still, this is we are finding uh, pockets of strength. Still, I wouldn't say that one large sector has suddenly come up, because usually if you look at the large sector, it's chemical, it's IT, it's pharma, it's consumer, and it's financials. These are some of the large sectors out there. There is no real leadership specifically in any one of them, right? It's happening in pockets. Yes, we are seeing some leadership in, let's say a hotel sector or stuff like that. So one needs to rely on other things right now, but it's a matter of time when you'll start seeing we had IT and metals for the last 2 years. Prior to that, we had the financials. So it will start showing up soon.
Right. So there are a lot of more questions that investors have been asking. I would urge investors to kindly book a call with us at our platform PMS AIF World. We have deep understanding of Girik multi-cap portfolio in terms of stock and sector allocation. We can help you answer some of your particular unique questions very well, because this is the webinar for which we had kept 1 hour, and we cannot just continue going on. That is where I'm just urging you, requesting you to kindly book your call with us, and we'll be happy to answer all your questions. And we are very good at that. And the last question which I would like to ask from Harshad. Harshad, can you please switch on your camera?
Sure.
Right. So you have come from mutual fund industry background, and what Varun also started off with in the beginning, and he mentioned that though a lot of investors have this view that in last 2 years, as we are sitting in the month of April, from bottom of equity markets in April 2020 till now, even your portfolio doesn't show an outperformance. The performance of Nifty from say 1st April till date is around 48 to 50%, and your portfolio is around 42%. Despite 2 years, in 1 year there is a 10% alpha. There is in 3 years there is a significant alpha, and in 10 years also there is a significant alpha. But what happens? Investors out here kind of base their decision more for index funds, keeping in mind last 2 years, and they believe that index funds are equally good. Why to pay 2% or 2.5% or a performance fee to a portfolio manager? And obviously, it is with complete knowledge that last 1 year or 3 year or 5 year, some of these index funds have actually underperformed. But despite that, investors want to ignore that and focus on the fact that in last 2 years they have underperformed. So since you come from mutual fund industry background, I want you to address this question. And also, when Varun mentioned that we fundamentally understand that we are in a structural bull run. So here also investors believe that if we are in a structural bull run, why do I need to add a fund manager or a portfolio manager like Girik? Why not put my money to a mutual fund or an index fund or a large cap fund or a multi cap fund? Because in any case, we are in a structural bull run, right? So this is the last question, guys, and then we will kind of thank you everyone. So over to you, Harshad.
Sure, Kamal. Thanks a lot. I'm glad you brought up this topic because if you look at the two themes that I talked about, the second theme was about the dispersion of stock returns, right? And what happens in a passive strategy, an ETF or an index fund, that let's say you buy Nifty. So when you buy Nifty, you are taking an exposure to all stocks in Nifty. And we saw that in any given year, in any kind of a market, there are always winners and there are always losers. So along with winners, you're also blocking a lot of capital in losers or laggards in Nifty, correct? So now this may not show up in a particular year or even 2 years, but over long periods of time, and Varun explained in detail that what we are essentially trying to do is have an investment process, so take emotions out of it, emotions of attachment, because I have also worked, Kamal, by the way, on the sell side as an analyst recommending stocks, and I have seen that analysts tend to fall in love with the companies they track because they believe the management, they establish rapport, and it's very difficult for them to recommend a sell on a particular stock. Similarly, fund managers, with their big positions, because they have interacted with the managements, they tend to fall in love. So what happens, therefore, is emotions actually is very suboptimal for decision making as far as investment field is concerned. So the investment process that Varun explained, that in essence, what we are trying to do is that we are trying to identify the winners. And in the context of, if you want to talk about NSE 500 or Nifty, so you actually do not want to block a capital in a laggard. And when you look at it this way, when you invest in an ETF or a passive fund, you are destined not to outperform it. Whereas the process that we have is, in fact, over medium to long-term periods of time, it almost ensures that we will outperform by a wide margin, because we are very ruthless in weeding out the laggards and losers, and we are sort of doubling up with the winners. And Varun explained that in great detail.
Yeah,
so I would say,
sorry, please go ahead.
So I would say that, yes, I know that mutual fund as an industry is focusing a lot on passive fund these days. So when Varun says we are in a structural bull run, what he meant, I think, was Indian economy is going to do very well, and therefore Indian markets are going to do well. But what we are trying to do for our investors is do far better than the average. We saw that, Sensex has delivered 16% return over long periods of time, right? What we want to deliver, and if you look at our 12, 13 years of track record, that we have handily outperformed the benchmarks. And that can happen only when you, select and keep the winners and ruthlessly weed out the losers. Now, in an index context also, the laggards and losers are weeded out, right? When the index constitution changes. But it takes a long time for that. What we want to do, or our process ensures that we do that well before, market recognizes that. Sorry, Varun, you want to add something?
Yeah, no, I think this is a very, very good, interesting point, and I am all for index investing if you ask me personally. But then you should have your expectations right. You should have you should be okay with a 12% return for a long period of time. If one has if you see our return over the last, let's say 12 years, we are about 10x, where the index is about 3x. Now, which is a huge gap if you think about it. But, in essence, why do index funds globally and why are they becoming so famous? Because they don't have any emotions. It's actually the most unbiased way of investing, because index fund is not fundamental at all. It's a completely technical fund. All they do is what goes up in price, they keep adding. What goes down in price, they keep removing. So if you look at 2007, you had Unitex, Suzlon, the entire Anil Ambani group companies, your Reliance Communication, Reliance Capital, everything, all these companies were in the index, right? What happened? 10 years later, most of these companies are bankrupt, right? Yes Bank was in the index. India Bulls Housing was in the index. Now, but the index has still done decent because it has managed to weed out the losers. Most of the fund managers can't do it because they get wedded to their stories, right? the index very smartly. Index, do you know what was the weightage of HDFC Bank in 2007? It was just 1.7%. It took it all the way to 10%. ONGC weightage was 8%. It took it all the way down to 0.8%. So it's very interesting how index manages it very well. All we are trying to do is trying to do it much faster, what Harshad said, and we have a much bigger universe to choose from, right? We have 600-700 companies to choose from, and we can be much more agile and hopefully use our intelligence to our benefit, rather than to our disadvantage. Many times in the market, why people do index investing is because it will. One thing is very good is that it will survive even after 20, 30, 40, 50, 100 years. An index will survive. You, me, I don't know if we'll survive, right? So it's very important to build your systems. But see, the good part about it, it's a liquid market, right? Tomorrow, if you feel okay, Girik Capital is not doing well, one can always, or if something happens to any of us, one can always redeem. But in essence, I'll tell you, the logic of index is amazing because it weeds out the losers and adds to the winners without any fundamentals, right? Which is quite amazing. All of us, which are such intellectual people, we are trying to beat an index which is actually an automated system. So it's an irony, but in essence, what we are trying to do is that we are trying to just do it faster with more agility, and we have a wider universe of stocks. So hopefully we will be ahead of the index, and we can do risk management also much faster. So that helps.
So just want to add one more point, Kamal, if you allow me, because I have also run mutual funds myself, and what tends to happen in mutual funds is because you are trying to beat the index, right? So you become very focused on the index. Even if you don't hug the index, you are aware of the index. And what happens in that, the way what Varun said, that HDFC Bank went from 1% to 10%. So what happens is a large part of the capital that investors give to the mutual fund managers, a large part of the capital gets blocked in index heavyweights. Okay, whether it makes sense or not. So possibly from generating alpha perspective, let's say only 60-70% of the capital is doing its work for generating alpha. Whereas the way we, and Varun explained in detail, we want every rupee of the investor to do that work for us. So we are not wedded to the benchmark. So of course there is a benchmark from a regulatory perspective. But if we think that a stock having 8% weightage in the benchmark, we believe that it's past its best and it is going to decline, we can sell it tomorrow. So we don't. We want to make sure that our capital is not blocked into laggards and losers.
Right, and this is the reason why we started PMS AIF World, because when I was working in Citibank 5 years ago, I used to feel there are only two branded products, ASK and Motilal, which Citibank is kind of promoting. But the thing is, mutual funds are kind of very well understood, but PMSs and AIFs are less understood. It is important to deep dive and try and find out some of the unique portfolios like yours and many others, which are actually not only working like fund managers but also working like investors. The way Varun, for example, explained the entire thesis, CANSLIM strategy, and how they kind of added metal and then they have exited metal and now they are adding retail. I could see, he's not talking like a fund manager, he's talking like an investor. And that is the exact approach that we also have, because I am myself an investor first and then advisor. So from that context, I really relate to, whatever has been discussed today. It has been insightful, it has been intuitive and very, very interesting. And I thank you everyone for joining us today, and we look forward to many more sessions. Thank you, Varun. Thank you, Harshad, for your time. Thank you, everyone.
Thank you, Kamal. Appreciate it.
And thank you to all your viewers. Thanks.
Thank you. Bye.